then see, here's the national unemployment rate where it hit 10.2% in October. And everybody knows that in Marion County, the unemployment rate is higher or lower than that 10.2%. Yeah, it's quite a bit higher. It's 13%. It's the highest in the state of Florida, actually. And you've been hit by three really major blows, which I can summarize here. The Ocala unemployment rate rises from 3% to 13%. Actually, there's something I'd like to point out from this that's going to be of interest a little bit later from these slides. And what that is that if you look at the U.S. unemployment rate, it came down more gradually than in both of those recessions and recoveries after those recessions than did the one in Marion County. Marion County's unemployment rate came down faster. The reason that's going to be of interest is because Global Insight and forecasts that are based on those, such as the one used by the state government, have the unemployment rate as far out as 2013 in Marion County being 11.2%. And what I'd like to say is why I think that estimate is a bit high, Marion County. Lost about 10,000 jobs in the last 3 years, and it did that because you were hit by triple blows. 3,000 jobs in construction down, 3,000 jobs down in manufacturing, 3,000 jobs in trade. And then, as if that weren't enough, just very recently you lose another 1,000 from TBW as they shut down. So it's been really rough, and I don't want to downplay that at all, that there are a lot of people who are feeling this and in trouble from it, suffering quite a bit from it. So you had all that growth with no increase in prices. And it's only after the boom starts getting underway a little bit after 2000, as retirees, those in their 50s, start moving here, that drives prices up a little bit. And then, of course, it's with the subprimes that they really take off, that things go crazy from the first quarter of 2004 to the first quarter of 2006. After that, of course, they tumble. Now, another thing to point out here on this particular graph is that it looks like that index has come back to 120 or so, 124, and that it's not back where it was in 2000 quarter one. But there's a problem with the construction of this index in that it's only the conforming mortgages. You're not picking up the distressed sales, the real estate owned properties and so on. So I think if you were to do this properly, you'd find that house prices now are pretty close to where they were when the whole thing started, which is in a sense good news, meaning that you're back in a situation where they shouldn't be plunging much more. I think we're hitting along the bottom there and maybe even just starting to turn up. My view of it is that we've got some chance that it'll recover pretty rapidly, a V recovery. That's argued by those who say when you have a really deep recession, you're also going to spring back fast. I don't think there's more than about a 20% chance of that. And the reason for that is the housing overhang, the fact that the labor market continues to be in distress, that you've got the commercial construction problems. All those mean that we're not going to have a V. Much more likely is we'll have a U or an L, whatever you want to call it, that is a recovery, but it's going to be kind of a sideways recovery, a gradual recovery. And so I think there's about a 50% chance that it'll be a U where you're coming back, maybe a 20% chance it'll be L where you're going about sideways. But the chance of a W that we're going to dip down again, I think is only 10%. We economists are going to be debating for the next 3 decades what really avoided the Depression. Whether it was monetary policy, fiscal policy, luck, or what it was, we don't know, and we won't for a while. But they did whatever it takes. Here's the 1-month Treasury rate that quickly dropped down to 0%, 0.25 to 25 basis points. And that wasn't enough. And so what else do? They extend, here's the loan extended to AIG. As after the experience of Lehman Brothers, the Federal Reserve decides that it's going to be the pawn shop of last resort. And they're going to shovel that money out to whoever needs it. And Ben Bernanke becomes the loan arranger, along with Paulson, to get those funds out. This is just a mistake, repeat of that. But here are the bank reserves. And so we would be eating our lunch and we'd look at charts like this and our jaws would drop. We'd have to pick them up later. They was just amazing that you come along from an ordinary level of bank reserves of $16 billion and it goes up to $1 trillion. And the Fed was using that for what? It was making sure that anybody who needed money had it. And we have a model in economics where you rent helicopters, and if the banks aren't lending, you just distribute the funds to the population in general, and you hope you're under one of those. But Helicopter Ben was just bypassing the banking sector and going directly to the investment banks and going directly to private industry to get the funds out there. The federal government had that $787 billion program, had a deficit last year of $1.2 trillion. And so it was, whatever it takes, we're going to avoid that depression. And it kind of worked. Something worked anyway. Here, and along about January, the Congressional Budget Office says, look, it's not going to be a fast recovery, but they're making their projection there and saying it's not going to be a depression. That's not going to happen. Bernanke, into February, starts talking about maybe there's a recovery in 2010. As any good economist, he puts in all kinds of caveats, but nonetheless, he was saying it may happen. And it's actually started happening, it turns out in retrospect, I think he was pessimistic. We probably hit the trough in the third quarter of 2009. Here's Christina Romer talking about the recession in December of 2008. She was saying this is going to be really, really bad, as she told Obama. But by March of 2009, well, here you can see her talking there. There's Tim Geithner, the Secretary of the Treasury, and then Christina Romer, head of the Council of Economic Advisors, Larry Summers, head of the National Economic Council. And Valerie knows what Geithner is saying there. You can see from his gestures, he's saying, now suppose you consider a 45-degree diagram and you put GDP on the horizontal axis, aggregate expenditures on the vertical. All you got to do is have a federal deficit to shift that aggregate expenditure line up, a little boost for monetary policy, and we can stop the downturn. It's exactly what he's saying. You can tell, can't you? Right. Yeah. And so you can see the reaction of Romer and Summers. They're saying, wow, you're a genius, Tim. Wish I'd thought of that. Quick, run tell the president. And so he does, and says that recovery is on the way. It's we're not going to have the depression. And Obama, of course, is overjoyed. And the good news spreads to Europe, and so we can see. And the Europeans who've been fearing a depression are saying that we had GDP actually going up in the third quarter of 2009. A nice bit of good news. And it comes to Europe. There's Sarkozy, telling Carla what's happening, and then even you see Angela Merkel smiling, which is a rare event. She's saying that GDP is recovering in Germany as well. So the point is we avoided the depression. Now what's the significance of that? The significance of that is now you can value those assets. Now that we're not going to have it, you can at least make a rough guess of what those credit derivatives are worth, what the structured investment vehicles are worth. You can get an idea of what a loan is worth, and so the banks can sort of recapitalize, and we're not going to have that clogging us up. Marion County, almost more than any other place in Florida, has a beautiful combination of combining retirees with industries of various sorts. Okay, what are the threats that are along there? And you may not agree with me. I do take this as a threat, hometown democracy. Hometown democracy, Amendment 4, as everybody I think realizes, says that you'd have to have a referendum on every comprehensive plan amendment, which would be just, first of all, an incredible derogation of elective government, representative government. And second, who knows what it would do to development? It's just a huge uncertainty that's hanging out there. The unemployment rate by 2013 here is going to be still high, but you're not talking about 11.2%. I think you're talking about 8% or 8.5%. And the reason for that is the demographics are with you. And the other reason for it is that this is a county that does indeed very aggressively go after other sorts of jobs. And the wages are attractive. The climate and the scenery, all that are attractive here. You are in an area that has fairly good access to the Orlando airport. You've got the University of Florida nearby, Santa Fe wrong one. The Marion County College, I guess it is now. Here, is that what it's called now? What is it? Okay, he says okay, whatever you want to. Yeah, Pete has already told me we're being casual with names today, so I don't see that. It's going to be you're going to have a rough year or so remaining. The unemployment rate is not going to come down until probably about the third quarter of 2010, but it will. And once it starts coming down, I think it will come down reasonably rapidly, hitting probably about 8%, 8.5% by 2013.